Okay, so you know how you sent out that article about Altria Group?
Yeah.
The one from the Motley Fool?
Uh-huh.
Well, we took a look, and
Yeah.
it got us thinking.
Right?
So it's about Altria Group, that's ticker symbol MO,
Mm-hmm.
and they're the parent company of Philip Morris USA.
Right.
So basically, they're the folks behind Marlboro cigarettes here in the U.S.
Marlboro. Big one.
Huge brand, right?
Yeah, absolutely.
And right now, they're offering a dividend yield of 7%. That's pretty significant.
7%. That's
Yeah.
that definitely catches the eye.
So what we want to do today is like a deep dive,
Okay.
using this article to see if dropping, say, $1,000 into Altria stock is a good idea right now.
Sounds good. Yeah, let's break it down.
All right, so first things first,
Yeah.
we got to look at the bigger picture, the
Yeah.
market context.
Right.
Right. The article's talking about early April 2025
Okay.
and the stock market. Well, especially tech stocks are kind of shaky.
Yeah, a little volatile, it seems.
The NASDAQ Composite and the NASDAQ 100 are both down more than 12% since the start of the year.
Ooh, that's not great.
No, not really. And that kind of uncertainty, it makes investors nervous.
Mm-hmm.
They start looking for safer places to put their money.
Yeah, makes sense. When things feel risky, you want stability.
Exactly.
So where does Altria fit into all of this?
Well, that's the thing.
Yeah.
While all those tech stocks are tanking, Altria's stock is actually up almost 10% in the same time frame.
Interesting. It's like they're moving in opposite directions.
Totally. So that begs the question, why is a company known for selling cigarettes doing so well when the rest of the market is freaking out?
It's a good question. You'd think with all the talk about health and everything that cigarette sales would be hurting even more.
You would.
Yeah, yeah.
So the article digs into their main business, what they call smokeables.
Smokeables.
Yeah. And it points out something kind of surprising.
What's that?
So, you know how cigarette sales have been going down in the U.S. for years?
Right.
Well, the last quarter, they mentioned another big drop, like 8% year over year.
That's a pretty steep decline.
Yeah. You'd think that would mean less revenue for Altria.
Makes sense. Fewer sales usually equals less money.
But here's the catch.
Okay.
They have this thing called pricing power.
Pricing power.
It basically means they can raise the price of cigarettes enough to offset those lower sales numbers.
So even though they're selling less, they're making up for it by charging more.
Exactly. Last year, their net revenue, after those pesky excise taxes, actually went up by 1.6%.
Really?
And the operating income for their smokeables division, that grew too, by 1.4%.
Wow. So they pulled in something like
$10.8 billion.
$7.8 billion from cigarettes.
And that's with fewer people smoking.
It's kind of like movie theater popcorn.
Yeah.
You know, they jack up the price, but people still buy it.
Totally. So they're squeezing more value out of a shrinking customer base. It's almost like a paradox.
It is. And it shows how some people are really loyal to their brand, I guess.
Or maybe just addicted.
Or addicted, yeah. But it can't last forever, right?
That's the question. How long can they keep raising prices before people finally quit or switch to something else?
Right. Right. And we got to look at their profit margin, too. For smokeables, it's a whopping 60%.
60%.
Yeah. It means for every dollar they make from cigarettes, they keep 60 cents after covering all their costs.
So that's pretty darn profitable.
Super profitable. Even with fewer people smoking, it's still a cash cow.
Okay, so the cigarette business is holding its own for now.
Right.
But let's be real, the future is probably not going to be all about lighting up.
Yeah. The article talks about Altria's push into smoke-free products.
Right, things like nicotine pouches, vaping, and maybe even heat-not-burn stuff down the line.
Right. They got to adapt to survive.
It's a huge strategic shift for them.
Totally. And they've set a pretty ambitious goal. They want to double their smoke-free sales to $5 billion by 2028.
$5 billion.
That's a big chunk of change, especially when you consider their total revenue now is about $20 billion.
Right. It shows they're serious about this whole smoke-free thing.
Yeah. They see the writing on the wall.
But here's the thing that kind of worries me.
What's that?
The article mentions that Altria is lagging behind some of its competitors in this transition.
Oh, really?
Like Philip Morris International, PMI. They're already close to having smoke-free products make up half their sales.
Wow. Half? That's a pretty big difference.
Yeah. It makes you wonder if Altria is moving fast enough.
Well, it's not just about speed.
What do you mean?
I mean, PMI, they operate all over the world. They've probably had more exposure to different smoke-free markets and products.
So they've had more time to learn and adapt.
Yeah, exactly. They've had a head start. Altria, they've been mostly focused on the U.S.,
Right.
so they might be facing different challenges, different regulations, different customer preferences.
So it's not just about catching up.
No, it's about understanding a whole new market and doing it quickly.
Okay, so smoke-free products are a big deal for Altria's future. But let's talk about something else that investors love.
Dividends.
You got it. And share buybacks.
Yeah, those are always popular.
So the article highlights how Altria has used buybacks to decrease their outstanding shares by like 14% over the past decade.
14%? That's pretty substantial.
Yeah, and they ramped it up even more in 2024.
So they're putting a lot of cash into buying back their own stock.
And those buybacks, they can boost the value of the remaining shares.
By reducing the number of shares out there, each share represents a bigger slice of the company.
Exactly.
Yeah.
Okay, now for the dividends.
Okay.
The article says their dividend per share has basically doubled in the last 10 years.
Doubled. That's impressive.
And the current quarterly payout is $1.02 per share.
If you hold their stock, you're getting a nice chunk of cash every 3 months.
Pretty sweet deal. And Altria's management, they've even given us a peek into the future.
Would they say?
They're aiming for mid-single-digit dividend growth every year through 2028. So around 5%.
5% steady growth. That's not bad at all, especially in this market.
And the article points out that they have the cash flow to back it up. They even included data from Y charts showing how their free cash flow per share has been steadily increasing.
Okay, so hold on. Why is free cash flow so important for dividends?
Well, think of it like this. Free cash flow is the money a company has left over after paying all its bills and investing in its business.
Okay.
It's basically the fuel for dividends and buybacks.
So the more free cash flow they have, the more they can pay out to shareholders.
Exactly. And Altria has a lot of it.
So that 5% dividend growth seems pretty realistic.
Yeah, they've got the financial muscle to make it happen.
All right, so let's get back to that $1,000 investment.
Right, the big question.
If you put $1,000 into Altria stock right now, based on that 7% yield, how much dividend income would you actually get in a year?
Okay, let's do the math.
All right.
So 7% of $1,000 is
$70.
$70. Not too shabby.
Not bad at all, especially compared to some other investments that might not be paying out anything right now.
And the article digs even deeper. They point out that Altria's free cash flow per share is actually higher than their planned annual dividend per share.
What does that mean for investors?
It's a good sign. It means their dividend is well covered.
Covered?
Yeah. It means they have more than enough cash flow to pay those dividends and even increase them if they want to.
Ah, so it's like a safety net.
Exactly. And the article even mentions that historically, their free cash flow per share has grown faster than their dividend per share. So there's potential for even bigger dividend hikes down the road.
Interesting. So it's not just a safe dividend, it's a potentially growing dividend.
Right. Okay, so let's sum it all up.
Right.
What's the big takeaway from this article?
Well, it seems like buying Altria stock right now could be a smart move.
How so?
You get a decent chunk of dividend income right away. And that income has the potential to grow steadily over the next few years.
Okay.
Plus, it's being presented as a safer bet than some of those high-flying tech stocks, especially with all the market uncertainty going on.
So it's like a counterbalance to the riskier parts of your portfolio.
Exactly. The steady, dependable cigarette business is providing the financial stability to reward shareholders, even as they try to navigate this whole smoke-free transition.
Okay, so investing $1,000 in Altria could give you a nice stream of dividend income that's likely to grow.
That's the gist of it.
But as we wrap up this deep dive, I gotta leave you with one last thought.
Okay.
That 7% yield looks great right now. But what about the long term?
What do you mean?
Well, how well Altria does with this whole smoke-free thing that's going to determine if they can keep paying those dividends and keep growing them way down the line.
Yeah, that's true. It's a big unknown.
They're playing catch-up to some of their competitors.
Yeah.
And it's a fast-moving market.
So it's something to watch closely.
Definitely. That long-term outlook, it's something to think about as you weigh this investment.
Agreed. The future of smoking, it's a bit of a wild card.
And how Altria plays that hand well,
Right.
that's going to impact their bottom line and ultimately their ability to keep those dividends flowing.
Good point. So yeah, do your research, think about the risks,
Yeah.
and make an informed decision.
Exactly. All right, that's it for our deep dive on Altria Group. We hope this has given you some food for thought. Until next time, happy investing, everyone.